All right, that does it for today's trading day. Dow ending off the lows, like Inez was just saying, closing off just about 340 points as we shake out the final trades of the day. The S&P off just over 1%. The Nasdaq off just about 1.5%. Let's talk about it with Anthony Saccaro. We have Providence Financial and Insurance Services President, and also David Waddell and Associate CEO and Chief Investment Strategist. Great to see you both. David, let me start with you. In terms of the action that we've seen this year, coming off a very weak 2022, it hasn't been shaping up much better so far this year. What do you make of the action that we're seeing?
Actually, so far in 2023, what's worked this year is what worked last year. International markets have actually held up better, which they did last year. Values held up better. The financials did fine today, relatively. It just continues to be valuation compression. I mean, the challenge for this year is that nobody really knows, right? So I think the high end of the S&P targets is like 5,000. The low end is 3,000. So on any given day, the market's just waiting for a report from the Fed on earnings, and we're only going to, average hourly earnings on wages, and we're only going to get 12 of those this year. So there are going to be 12 data points this year that matter, and in between those, we'll just fluctuate back and forth.
Anthony, David says nobody knows. We trust in you to know. Are we going to continue this type of action? What do you see as a potential low for the S&P?
Well, for sure, David is right. No one knows for sure. I think the S&P could go down another 20 or 30% from here, which then puts us in that 3,000 range that we're talking about as well that David has suggested. So I don't think there's anything unrealistic about that at all. It's all going to boil down to what the Federal Reserve does, and the Federal Reserve is all going to boil down to what interest rates, what inflation does, and inflation is going to boil down what happens to the unemployment number. It's the unemployment number right now that is keeping everything at bay. It's keeping inflation high. It's keeping the Federal Reserve on a very aggressive path. They've told us that they're going to keep raising rates. The challenge, though, is that when you have your foot on the gas, and you're coming up to traffic and you see some brake lights start to get on, you want to take your foot off the gas. You want to act with a little bit of caution. You want to approach a traffic cautiously, slowly, looking around, and you don't want to keep your foot on the gas because you're going to crash into the cars in front of you if you're not cautious. And they kept their foot off the gas too long at the beginning of the inflation cycle, and they didn't catch up to speed. All the cars were passing them, and now the cars are slowing down. And as they're approaching, they're keeping their foot on the gas. I'm just afraid that they're going to drive this economy into a recession that's going to be much deeper, much longer than it needs to be. They need to ease off the gas and just look at what's happening with inflation. Inflation has already started to slow down, but they need to take a look at that, take a pause, to coast a little bit before continuing to press down on that gas pedal.
David, how aggressive do you expect the Fed to be this year? And talking about Anthony's point, easing up a bit, when exactly do you expect that to actually happen?
I mean, we got a big data point today that people glossed over, which was Bullard sort of softening a little bit, and he's been an ultra hawk. What freaks out the Fed is inflation, right? We topped out at the CPI at 9%. Now we're at 7%. But during that period of time, over the last 6 months, wage inflation's gone nowhere. So to get the average hourly earnings percentage down from 5% where it is today to 3% or less where they're comfortable is going to require 2 million people to lose their jobs, right? So the sooner, let me say it this way. Last year, it was the Fed versus the markets, right? They needed valuations to come down. They wanted equities to go down. They wanted bonds to go down. They wanted housing prices to go down. They got that. This year, it's going to be the Fed versus employers. And what the Fed has told employers is we're not going to stop until you fire 2 million people. So it's great that Amazon laid off 18,000 for their purposes, but we got a long way to go. So there's going to be a whole lot more reductions in payrolls to try and force that wage number down. And based upon the jolts yesterday, we still have 10.5 million jobs available for 6 million people unemployed. So that's why the Fed feels like they've got to be tighter for longer. But I think one more quarter in rate hikes, and we should be done because M2 is actually shrinking year over year. I mean, when you add the rate hikes at this pace, and you add quantitative tightening into the mix, there's an enormous amount of liquidity being sucked out of the system. And I agree, they need to pause. And Bullard sort of suggested that maybe today.
Sounds as though, Anthony, we're still going to have no cuts until 2024 and somewhere a terminal rate between 5 and 5.5. Is that what you think they'll do?
Yeah, I do. I think that I'd love for David to be right. I would love for them to just have one more and then pause. The forecasts that I've read have said that it's going to take us to 5.5%, which then means they're going to have to go another 1 or 1.5% from here, where we are. So the reality is that as much as I'd love for them to pause, I don't think that they're going to. And that unemployment number, until we can get back down to where there's only 1.2 jobs available to every worker, like we were pre-COVID, they're going to keep their foot on the gas. Right now, there's 1.7 million jobs available per worker. That number needs to come down to 1.2 or so, which means the unemployment rate needs to go up, as David noted, about 2 million. That puts us in a 5 or 6%, closer to 6% unemployment rate. That's where we need to be in order for inflation to come down, for the Feds to be comfortable pausing.
All right, well, we'll get that reading on the jobs market tomorrow, but certainly sounds like we have more pain ahead. Anthony Saccaro, David Waddell, thanks so much for joining us here this afternoon.